as the US stock market has soared to new heights on the wings of just 7 companies, the so-called Magnificent Seven. But are investors overexposed to these stocks now and taking an unseen risk? Let's take a moment to shine a spotlight on these Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla. In 2023, these tech titans took the reins of the US stock market, steering it towards unprecedented peaks. Their combined market cap swelled to an astonishing $12 trillion, equivalent to the next 42 companies from various industries. A historical achievement indeed. However, it's not just their market cap that's grabbing headlines. The Magnificent Seven have consistently outperformed the broader market, contributing to almost 65% of the S&P 500 index's returns in 2023. This performance has led to their significant concentration in many investors' portfolios, making these 7 stocks the majority owned by all. But this high concentration raises a critical question. Are investors now overexposed to these stocks? Overexposure can lead to significant risks. For instance, the valuations of these stocks are a concern for some investors, as their forward price-to-earnings ratio is 42% higher than the overall market. Moreover, any negative impact on these companies could ripple across portfolios, increasing overall portfolio risk, particularly for passive investors. This situation is compounded by a self-reinforcing cycle where higher stock prices attract more inflows from passive funds, further increasing these stocks' concentration. Additionally, regulatory guidelines are blocking some large US investment funds from buying more shares of these companies, increasing the uncertainty surrounding these stocks. As the Magnificent Seven continues to dominate the market, we must ask, is it time to diversify and consider other investment options? As we delve deeper into this topic, let's remember that diversification is not just about spreading risk. It's about making room for other potential market winners and ensuring that our investment eggs are not all in one basket. How have the Magnificent Seven performed, and what risks do they present? These 7 titans of the tech world, Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla, have been the driving force behind the S&P 500's performance in recent years. Unprecedented in their dominance, they make up a staggering 28% of the S&P 500 and have contributed to nearly 65% of the index's returns year to date. But what does this mean for investors? Their performance has been nothing short of stellar, but it's important to remember that past performance is no guarantee of future results. In fact, the Magnificent Seven have high price-to-earnings ratios, a measure often used to determine if a company is overvalued. These ratios are significantly higher than the broader S&P 500, suggesting these companies are more expensive relative to their earnings. This raises the question of sustainability. Can these companies continue to grow their earnings at the same pace in the future? The answer is uncertain. While earnings growth estimates for these companies are higher than the S&P 500, predicting long-term earnings is no easy task. It's a bit like trying to predict the weather a year from now. While it is possible, are these stocks priced for perfection? There's also the risk of overconcentration. Having a significant portion of your investment in a handful of stocks can be a double-edged sword. On one hand, if these companies perform well, your portfolio soars. On the other hand, if they falter, your portfolio takes a hit. This concentration can increase overall portfolio risk, especially for passive investors who follow the index. Moreover, this high concentration has led to a self-reinforcing cycle. Higher stock prices attract more inflows from passive funds, driving the prices even higher. This cycle, while beneficial in a bull market, can exacerbate losses in a downturn. While these stocks have led the charge, their dominance also presents considerable risk. It's like being in a boat with all your weight on one side. Sure, you might go faster in calm waters, but when the waves come, you're more likely to capsize. As we move forward, it's worth considering how much of your portfolio is in the Magnificent Seven and whether it's time to rebalance. If you've made it this far, consider giving us a like and subscribe to support our work. We really appreciate it. What other investment options should one consider given the current market dynamics? As the market grapples with the dominance of the Magnificent Seven, it's worth exploring other investment avenues. One such option is the equal weight S&P 500 or RSP Exchange Traded Fund, or ETF. Unlike traditional S&P 500 funds, where the Magnificent Seven can have an outsized influence, Equal weight ETFs allocate the same weight to each stock. This approach offers a more balanced portfolio, reducing the risk of overexposure to a handful of mega-cap growth stocks. In addition to equal weight ETFs, investors might consider tilting their portfolio towards small-cap and mid-cap exposure. While these stocks may not have the headline-grabbing appeal of the Magnificent Seven, they often provide attractive growth opportunities. Moreover, a tilt towards value orientation could also be beneficial. Value stocks, which are shares in companies considered undervalued compared to their intrinsic worth, have historically shown strong performance over the long term. Another alternative could be dividend growth stocks. These are shares in companies that have a track record of consistently increasing their dividends. Such stocks can provide a steady stream of income, which can be especially appealing in a volatile market. They also tend to be less risky than growth stocks, making them an attractive option for risk-averse investors. Finally, let's not forget about small caps. While they may not grab the headlines like the Magnificent Seven, small cap stocks can offer significant growth potential. They often operate in niche markets, with plenty of room for expansion. Plus, they tend not to be as closely followed by analysts and investors, which can sometimes lead to attractive buying opportunities. Diversification is key in investing, and these alternatives offer opportunities to mitigate risk and potentially enhance returns. Why is diversification so important in investing? Let's delve into this. Think of diversification as a safety net for your investment portfolio. It's about spreading your investments across various asset types, sectors, and regions, reducing dependence on any single investment. This way, when one investment doesn't perform well, the negative impact is cushioned by the performance of others, thereby reducing the overall risk. Now let's apply this concept to our Magnificent Seven. These stocks have indeed been stellar performers, but what happens if one or even a few take an unexpected downturn? The concentrated presence of these stocks in a portfolio could mean a significant hit. This is the risk of overconcentration. It's like putting all your eggs in one basket and then discovering that the basket isn't as sturdy as you thought. Let's not forget, the market is dynamic, and the leaders of today may not necessarily be the leaders of tomorrow. Diversifying your portfolio ensures that you're not overly reliant on the performance of a select few. It also positions you to potentially benefit from other emerging opportunities. Now, how about considering alternative investment options? Equal weight S&P 500 ETFs, like RSP for instance, offer a balanced exposure to all stocks in the index, as opposed to being heavily weighted towards a few. This way, your portfolio is not overly dependent on the Magnificent Seven, or for an aggressive investor already holding the Invesco QQQ, a popular ETF that features Apple, Google, Microsoft, and more. Invesco QQQ ETF tracks the Nasdaq 100 index, giving you access to the performance of the 100 largest non-financial companies listed on the Nasdaq, but its concentration of Magnificent Seven is nearly 40%. An alternate equal weight ETF, the QQQE, is a passively managed fund by Direxion that tracks the performance of the Nasdaq 100 equal weighted index. QQQE may be a worthy alternative to QQQ to lessen the concentration for a portion of your current QQQ or SPY holdings. Then, there's the potential of dividend growth stocks and small caps. While they may not have the current limelight like our Magnificent Seven, they do offer opportunities for growth and income. Dividend growth stocks, for example, can provide a steady income stream and potential for capital appreciation. Small caps, on the other hand, offer the chance to tap into the growth potential of emerging companies. So, as we navigate the dominance of the Magnificent Seven, let's remember this. Diversification isn't just about spreading risk, it's also about creating opportunities for growth. It's about finding a balance that aligns with your investment goals and risk tolerance. In the face of the Magnificent Seven's dominance, diversification may well be an investor's most powerful tool. So, what have we learned today about the current state of the US stock market and the dominance of the Magnificent Seven? Well, we've discovered that these 7 stocks, Apple, Microsoft, Alphabet, Amazon, Meta, Nvidia, and Tesla, have had a significant impact on the S&P 500's performance in 2023. Their concentrated ownership has also raised concerns about potential overexposure, given their high valuations and the risk this poses for investors. We've also explored alternatives for investors looking to diversify their portfolios. Equal weight S&P 500 ETFs, like RSP for instance, offer a tilt towards more small cap and mid cap exposure, as does the equal weight Nasdaq 100 or QQQE ETF. There's also the potential for a value orientation or even active strategies, which have been somewhat overlooked due to the performance of the Magnificent Seven. And let's not forget about the potential of dividend growth stocks and small caps. Importantly, we've underlined the significance of diversification in investing. It's a time-tested strategy that can help mitigate risk and deliver more stable returns over the long term. While the Magnificent Seven continue to rule the roost, savvy investors may find greater value and lower risk in diversification and a broader perspective on the market.